starting the recording right now. Very good. Okay, let's get started here. All right, so we're going to talk today about how to put the odds in your favor, and that is a play on words because I'm going to be using the married put play all through 2015, even if you're lousy at picking stocks or reading charts, and that particularly is my weakness. Okay, I'm not good at just having the feel for the stock market, just being kind of an intuitive trader. That's not me. I'm not the guy that is the prophet of Wall Street. You know, I'm not the fellow that can pick the winners every time or predict the highs and lows. I'm just a guy that learned how to use a specific structure for trading, and it's kind of fortunate because guess what? I can teach that structure. Not only have I used it to turn my trading life around, but I've also used it to help many thousands of others all over the world. Whenever you're listening to a class like this, probably the first thing to come to mind is this for me? And I do want you to ask yourself that question because you're going to want to have a really good reason for sticking around for the next 5 minutes or so, right? Okay. Well, if you think that it's important to you to protect yourself from loss, if you think you'd like to know how to take income from stocks, perhaps more than just the traditional ways like hanging around for dividends, if your stock pays dividends, or using covered calls, which also limits your upside. If you'd like to know how to take income from stocks, we have 12 different ways that we do it. If you'd like to participate in growth, one of the biggest complaints that I've heard from people that do covered calls trading is that their profits get limited. You know, they turn over their winning stock over to somebody else, and they get to keep their losing stocks. So not cool. We're also going to show something called bulletproofing, how to essentially bulletproof your stock and no longer have risk, at least for the time that you are in a put option. Okay, you're going to own stock. You're going to also own a put option that protects the value of that stock. But what if you didn't have to pay for that put? Or what if that put option was paid for by one of the 12 income methods? Kind of cool. And wouldn't it be nice to also have upside potential rather than limiting yourself like a covered call would? So the question is this for me? Well, if you answered yes to any one of those questions, then yes, it is for you. I'm going to be taking an excerpt from the blueprint. I'll be teaching about my method for keeping losses in the market in stock trading. Keep your losses down to 5% or less regardless of what your stock does. And that's going to seem like a tall promise, but I'm going to deliver. See if I don't. Go ahead and take a look. By the end of today's class, I want you to let me know, hey, Kurt, you delivered, or hey, Kurt, you did not deliver. Okay. We're going to also, from the blueprint, we're going to take one of the 12 income methods, and I'm going to be sharing income method number 5. Income method number 5 is a riskless spread trade. Now, that sounds like snake oil, doesn't it? It sounds like, okay, Frankenberg, you're going to tell me that it's possible for you to put together a spread trade that pays a credit, actually might even pay you twice, but it doesn't limit your upside growth potential, and it doesn't have any risk to it? Well, yeah, in the context that I show this, it will have no risk, okay? So if you're a trader and you've had some difficulty with getting this thing off the ground, I want you to say goodbye to the fear of pain and losses and say hello to trading confidently with a winning system, even if you stink at picking stocks, even if you can't read charts, okay? And even if there's a catastrophe in the market, you will be safe. Okay, we actually had one fellow, I'll tell you about a little bit later on, who traded. He was long stock all through 2008. Now, in case you weren't trading in 2008, let me give you just an excerpt from that. Early in 2008, Apple Computer, which is now I think just Apple, Apple was trading at over $200 a share, and toward the end of 2008, it was trading at $88 a share. So that's a 56% crash. Now, during this time, you'd think that Apple had bad news. No, it came out with quarter over quarter, bang up, never before recorded awesome sales. In fact, their profits from 2007 were $3.5 billion, and their profits in 2008 were over $6 billion. Okay, Apple was making money for itself, but the market was not making money for people that were in Apple. Okay, so if there's a catastrophe in the market where people will leave it, if there's a crash, wouldn't it be nice for you to be safe? One of the fellows that I'll be telling you about later on was long stock all through 2008, and his loss was 1.5%. That means that at the bottom of the market, March 2009, he was able to buy in with 98% of his capital, all right, and then still be able to ride it to greater gains. I'm going to show some trades from that fellow's account here today. What's the problem when you trade stocks? Okay, the problem is losses. You know, we don't like to expose ourselves to losses, but it's necessary if we're going to trade. Okay, risk is part of the game. The stock market is simply an arena where you buy and sell risk. That's all it is. Okay, so when we don't make enough when we're right, or we lose too much when we're wrong, then we get into trouble. And guess what? That second one is something that we can control. We can control. We certainly can't control how high a stock goes. We don't know, all right? But we certainly can control how much we lose when we're wrong. It's a famous saying of Warren Buffett's. He says, rule number 1 is don't lose, and then rule number 2, of course, is refer back to rule number 1. Okay, so here's a guy that doesn't lose, right? Well, let's see. Like many folks that are online today, I got exposed to trading stocks and options through the classes of a legendary real estate investor that turned into a stock trading guru. His name was Wade Cook. And in the late 90s, he started off this kick where now there's dozens of people that offer courses and classes and weekend seminars where you can learn how to trade covered calls. Well, I did that. I went ahead and in the late 90s, I was buying stocks. I was selling covered calls against those stocks, and I got called out. Like they say, everyone's a genius in a bull market, right? So I was doing very, very well and getting very cocky. I was just following directions. My stock trading guru told me that, hey, you know, in order to really do well, you should trade stocks that are between $5 and $20. So I picked this one called LiPo. That was at $17 a share. He said, you know what? You should get stocks that are fairly volatile. And I did. You know, the $20 calls were selling for $3, and that was 6 weeks out. And he said, you know what you should also do is you should margin, because when you margin, you double your return. And I thought, okay, I'll do that. Well, here's what I'm looking at. I'm looking at getting called out at $20. I'm looking at LiPo going up and me getting called out at $20 a share. And shoot, even if it goes down to $14 a share, I'm at break even, right? Because I've collected $3 for selling covered calls. If I get called out, I'll make a $3 profit on the move of the stock, and I get to keep my $3 premium from that covered call, right? So that's $23 in for every $17 out. Well, can't lose, right? Here's what I did. I margined myself to the gills. And next morning, I got in trouble. I don't know if it was next morning. It was probably a couple days later. Okay, but I got a call in the morning right after we missed our, what do you call it, the FDA approval. To add insult to injury, 4 months later, FDA did go ahead and approve the drug that LiPo was selling. But I got killed. I got killed overnight. I bought in at $17 a share. My broker calls me and says, "Hey, Kurt, LiPo opened at $9 this morning, and it's been headed down. Shoot, there it is at 8.5. Okay, there it is at 8.25. This is before they used decimals. And I said, "Oh my God, what do I do?" He says, "Well, they're asking for a margin call." And I had lost almost all of my life savings in just that one play. So let's count the cost. The Weekend Covered Calls seminar cost $3,000 to attend. The software that they were hawking at that seminar was more than that. And I spent a lot of time trying to find the right kind of trades. And I did very well for a very long time. And then I got killed. Okay, nobody ever taught me how to stay out of trouble, and so that was no fun. That was how this kid got hurt really badly, and I decided to never ever allow it to happen again. Okay, now I did learn how to figure stuff out. Okay, I did learn how to not get hurt in the market, but it's more important that you learn this. Okay, so what I'm going to do real quick is I'm going to do a poll, and I'd like to know what statement best describes your performance in the last 12 months. Okay, now I'm not going to look at anybody's name. Actually, I don't think it even allows me to. Perhaps in a later printout or something like that I could see. But right now, this is anonymous, okay, and I'm not going to peek. And nobody else gets to peek. I'd just like to know, honestly, where you found yourself at the end of last year, okay? Maybe think of 2014's record, or maybe think of April to April. Today is April 21st, 2015. Think of last April to today, okay? I think you can vote in just one category in this particular poll, although some polls you're going to be able to vote in more than one category. Okay, now that thing is almost completely filled out, and I'm going to leave it up there for another 5 seconds. And you know what? I'll bet you we've got some blueprint owners in this audience. I know William is. William texted in at the very beginning. I know you're a blueprint owner. And the reason I say that is this. Okay, let me go ahead and close this poll, and I'm going to share the results. Okay, so 33% picked more winners than losers, right? Picked more losers than winners. I'm sorry, let's start over. Picked more winners than losers and made money. All right, not surprising. If you win more often than you lose, it's not surprising that you would make money. 22% picked more losers than winners and lost money. Okay, also not surprising. 0% today said this, although very often I have a lot of folks say this, but today 0 said it. Today I picked more winners than losers, but still managed to lose. Nobody said that. But here's something surprising. It would be surprising. Usually I get single-digit percents, and today I've got 33%. So I'm willing to bet that I've got some blueprint owners in the audience. We're going to find that out here in a little bit, okay? Because 33% said that I picked losers more often than winners, but I still managed to win. How about them apples? Okay, and that's certainly possible. All we've got to do is make sure that when we lose, we don't lose too much, and when we win big. All right. 11% say I'm ready to quit just to stop the hemorrhaging. So, guys, I'm going to encourage you not to quit. I'm going to say, look, there is a better way. I had to embrace this fact. The big problem that got me into trouble was not bad breaks. It wasn't luck. It wasn't the market. I couldn't blame anybody but me. It was my behavior. And that was bad news, and it was also good news. The bad news is, hey, I had no one to blame but myself. The good news is that, hey, I have control over my own behavior. I can change that. And by changing the behavior, I can also change my outcomes. I learned to reverse this behavior with some practical strategies and became a winner in the stock market. And I'm sure that you're, real happy for me. But honestly, it's not about me, is it? You probably want to know if I can help you with your trading success. And I'm going to say that I can. Okay? All right, so why hasn't the problem been solved yet? The problem of losses. Well, we've been looking in the wrong place. We've been trading the wrong way. And I'm going to say that it's better not to be right, but to trade right. Following your gut instinct is not always the way to go. And a lot of times folks believe that, hey, I've developed the best system. I had a fellow come to me the other day. He doesn't use my system, but we like to talk shop a lot because he trades stocks and options, especially options. And he's always coming to me and saying, geez, Kurt, I think I'm going to, really make it this year. I'm going to become a millionaire, this year in the stock market. And I'm thinking, wow, you're trading, 5 figures. You're gonna take your 5 figures and make it 7 figures this year, are you? All right. Well, I don't know. The system doesn't always work out the way that we hope it will. Okay. Also, stop orders. Some of you that answered today's email, you've been doing this. You've been using stop orders, And stop just means stop here and take your loss on the chin. And don't pretend you don't know what I'm talking about. What happens is that stop does not mean stop at this price and sell. It means stop and sell at any price now that the order's been triggered. Here's an actual play that I got into back in, I think it was 2006 or 2005 or something. Well, what had happened was I got into Daktronics, and a couple of days later it opens at a $35 hit. I'm sorry, not $35, 35% hit. So if I were trading a stop order, even if that stop order was like 10% below my buy-in, I would have taken the 35% hit. Now, as it is, I took about a 5% loss and moved on. But if I had not decided to move on, look at this. 1, 2, 3 months later, it's trading up way higher than where I bought in. So if I had stayed in, I would have been okay, particularly because during this time I had a put option in place that was protecting me, keeping my stock from ever losing me more than 5%. Okay, so if you're a buy and hold kind of a guy, hey, that would be the way to go. And if you're like me and you just say, hey, I'm going to cut bait and run, you could get out with a 5% loss, all right, instead of like a 10% on a stop loss order. And a stop loss order would not have helped us here. All right, let's also talk about this, fundamental analysis. Fundamental analysis assumes two things. Number one, you're smarter than the rest of the market. Okay, now Warren Buffett may be smarter than the rest of the market. It has worked out for him, although he has had over 60 years to refine his approach, okay? Now, the other thing that it assumes is that the rest of the market is going to catch up to you. The rest of the market will eventually be as smart as you are. All right, so that's what fundamental analysis is all about, is that you're thinking, okay, this stock is worth this much, but nobody's buying it at that. I can get it at a bargain. And then later on, everybody's going to be as enlightened as you are, and they're going to push the price up. That's what fundamental analysis is all about. Technical analysis, I don't know. That's the bold assumption that the past will tell you what the future holds. If it was 100% accurate, there wouldn't even be a market. But guys, look at this. You see this? Rough and tumble, kind of all over the board type stock. I was trading this with my system during this time frame and had no fear at all. And the reason I had no fear, even though there was huge swings up and down, this is XL Maritime Carriers, by the way, in 2007. I had no fear because when I got in, I had no way to lose any more than about 5% if the stock went down. And 3 weeks in, I was what we call bulletproof. I'm going to explain bulletproof a little bit later on, but bulletproof essentially means that you no longer have anything to lose. You no longer will lose. All right, and then 3 more weeks later on, got out at 10.22%. Now, here's the deal. That doesn't sound super exciting to make a 10% return in 6 weeks. Some folks might be excited by that, but not everyone. And here's the thing. You shouldn't be excited over the 10% gain. Even 100% gain you shouldn't be excited over. What you should be excited over is the fact that I couldn't lose more than 5% ever. And then later on, couldn't lose anything at all. For half the life of this trade, couldn't lose. Okay, and that's kind of exciting. Hey, some folks believe that diversification is what's going to keep them out of trouble, but diversification really just means putting your eggs in too many baskets. If you spread your assets over 35 different positions and the whole market crashes, now you have 35 bad positions to manage. Diversification is not your answer. It wasn't the answer in 2008. Mutual funds, which is about as diversified as you can get, mutual funds had a return in 2008 of negative 40% or worse. Okay, so not cool. And by the way, if you think that insider information is going to help you out, it'll probably just get you a change of address. And though you might be good at decorating, you probably won't like your space. All right, so there's that. Okay, folks, I've gone through what the answer is not. Okay, the key to winning plays is not picking stocks. The key is not timing your trades. The key is something completely different that goes almost unnoticed, because most people, when they're looking for answers, they look at one of those two. How do I pick stocks? How do I time trades? Or, a combination of the two. But I'm here to tell you that the way to actually do this is to find out the mathematical reason why people lose in the first place and then turn it upside down. And it's possible to do exactly that. Okay. Now, folks, I hope everybody's tracking with me so far. I'm going to do something here real quick. I'd like to just take a short interlude, short intermission. It's 10:22. It's my birthday. You can send me something on October 22nd if you like. Okay. It's 10:22. Let's just do a brief poll. I'd like to see where everybody's coming from. Are you a Power Options subscriber? Is this maybe your first time at a Radioactive Trading webinar? Or have you been to others? Have you been thinking about buying the Blueprint or Home Study Kit? Or have you recently bought the Blueprint or Home Study Kit? And I'll bet that we'll actually have some good representation on the I've recently bought. And you know why? Because we had such a high incidence of people saying, even though I lost more often than I won last year, I won overall. I made money overall. We had 33% say that. So, all right, let's leave that for another 5 seconds. 3, 2, 1, close. Okay, all right, now, here's something surprising. 0% said I'm a Power Options subscriber. And Power Options sends me a lot of traffic, a lot of business, a lot of folks that, want to learn about trading and staying out of trouble. Well, Power Options, I'm not affiliated with Power Options in the sense that I'm not their employee or partner or anything like that. I have partnered with them to do these webinars, but I don't own any share or stake in the company. Now, having said that, I will tell you that Power Options is the best platform for trading options. If you're an options trader, they support covered calls, naked puts, diagonals, double diagonals, iron condors, butterflies, just about everything you can imagine doing with options. They will search and find the best plays that are happening right now. And furthermore, they'll help you track it. Okay, so anyway, I'm doing a little sales pitch here for Power Options. Let me give everybody here a link to Power Options, www.poweropt.com/RAT for Radioactive Trading, /RAT. And I just sent that in the chat box. That's a clickable link. Don't click it right now, okay? You've got things to do right now. You've got some learning happening, all right? But what I'm doing is making sure that everybody has the opportunity to get 2 free weeks without obligation, without a credit card. And if you're an options trader and you get nothing out of today's presentation, I'll tell you what, you will, all right? But in case you don't, I want you to go away with at least that, okay? 2 free weeks of Power Options. Okay, so let me go ahead and go through the rest of this. 18%, it's my first Radioactive Trading webinar. You're in for a treat because I've just kind of set the stage, and now we're going to show the techniques, okay? 55% say I've been to other Radioactive Trading webinars. Back because you're learning. 27% thinking of buying the Blueprint or the Home Study Kit. Good for you. 55% have recently bought, have already purchased the Blueprint or Home Study Kit. Fan-freaking-tabulous. Okay. I want to remind you folks that have already picked up the Blueprint or Home Study Kit to use your support. Right now I'm coaching a number of people that are in the middle of income method number 5 trades, income method 11 trades. We got one fellow in income method number 12 trade, and we're coaching winners. It's a blast. Okay, so here's how people get ruined in the first place. Okay, and what we're going to do is we're going to turn this upside down. The Martingale principle is the math behind how most gamblers lose. Okay, and though we're not gamblers, there is a lot of overlap between what we do and gambling, isn't there? Okay, so the Martingale is called Gambler's Ruin, and this beastie, I've personified him here, okay, or I've monsterified him here. He lives to devour your savings, and he thrives best in an environment of charged up emotion, fear of loss, greed of gain, or just plain complacency. Now, his plan of attack is simple. Each loss creates an even more desperate move to regain lost ground. Now, here's how the math really works. Let's say that you begin with $10,000 and you have a 20% loss. What do we got to do to get back to break even? Most folks just off the cuff would say, well, you got to have a 20% gain. But that's not how math works. A 20% gain will not bring you to break even. Think about it. $10,000 minus 20% is a $2,000 loss. So now you're left with $8,000. Then you take your $8,000 that's remaining and you play it for a 20% gain. Hey, we're back to, no, we're not. We're not back to where we started. 20% of 8,000 is 1,600. You add that back in, now you have 9,600. So you lose 20, make 20, and you end up 4% behind. And that doesn't even take into consideration commissions and such. Okay? Here's how the math really works. If you have a 20% loss, you need a 25% gain to get back to where you started. Now, this is the Martingale principle, okay? What happens is it becomes a very slippery slope. If the 20% gain doesn't take a 20%, I'm sorry, the 20% loss doesn't take a 20% gain, it takes a 25% gain. Well, then what about a 25% loss? Now we need a 33% gain. A 33% loss needs a 50% gain, and think about it. If you have a 50% loss, you're required to double what you have left in order to get back where you started, okay? If you have a 50% loss, say you have $10,000 and you lose 50%, you have $5,000 left. You've got to have a 100% gain to get back to where you started. Now, real quick, I'm going to do this. I'm going to ask you all another poll, okay? Simple game here. If you have a 100% return when you're right, but a 50% loss when you're wrong, but you're right only 40% of the time, can you win this game? Can you win this if you are wrong more often than you're right? It's a good question. One that deserves a good answer. Okay, so let's go ahead and check that out. Okay, I'm leaving that to fill up. We got representatives in 2 of the 3. Okay, let's let her keep going. Now, the reason I do some of these polls, we got all 3 categories voted in now. The reason I do these polls is because it's like teaching like Socrates did. Okay, I'm not comparing myself with Socrates, but the Socratic method is that Socrates would ask his pupils questions and lead them to an answer rather than flat out just giving them an answer. Okay, and I think it's better that way. All right, so we've still got votes coming in. Let me leave it up for another 5 seconds. 3, 2, 1. Whoops, I blew something here. Okay, and close. All right, so it appears to add up to 101%, but that's because of rounding. Okay, so 38% say no. The 50% losses offset the 100% gains. You know, you're never going to get ahead. All right, and then 13% said, yeah, it's possible. You know, it's possible to win this game, but it's highly unlikely because 60% probability of a loss stacks the deck against you. And then 50% said, yes, there's a way to almost guarantee winning. Okay, so what's the answer? Let's find out. Okay, here we are on radioactivetrading.com, and in the resources area, there's the trade simulator tool. What we're going to do is we're going to plug in here a 50% return, but also a 100% return, but also a 50% loss. But we're going to make our probability of a loss high. We're going to make it 60%. Now, if we start with $10,000 and we invest fully every time, watch what happens. Boom. Oh, we're bankrupt after 6 trades there. Okay, let's try it again. Oh, bankrupt after 12 trades. That's after we doubled our money. Right at the very beginning, we might mistakenly believe we have a winning system, okay, but then still got hurt. Oh, bankrupt after 26 trades. It seems like you're going to do well for a while, and then you're going to go bankrupt. At this particular deal, hey, it's random, okay, so we have 2 wins followed by 2 losses, and then 3 wins followed by 2 losses, and 3 more wins followed by a number of losses, and then we end up getting killed, okay? All right. But is there a way for us to fix this? Yes, watch. Watch this. I'm going to take and invest only 10% of my capital in each play. And now we're making it to the end. Even with more losers than winners, even starting out with losers and then having our losses outnumber our wins, we're still doing okay. Starting with 10,000, ending up with 18,000. Let's try that again. Okay, starting with 10,000, ending up with 15,005. Let's do it again. Starting out with 10,000, ending up with 32,000. Let's look at the drawdowns. The drawdowns really aren't that bad, are they? Okay, why is this? It's because we've taken and changed only one thing. We've changed our position size. Now that should be significant. I'm going to get back into here. I'm going to show you why that's significant and how that works, okay? Because what happens is on this Martingale chart here, a 20% loss means you need a 25% gain to get back to where you started. 25% loss, 33% gain. 33% loss, 50% gain. You see, each of these red losses require an ever-increasing, exponentially higher amount that we have to gain to get back to where we started. But here's the thing. If a 100% gain means that we need, if a 50% loss means that we need a 100% gain to get back to where we started, if that's what that means, then, whoops, let me go back. There we go. Does it mean that we need a 10% gain to get back to recover from a 5% loss? No. A 50% loss, we need a 100% gain to recover from, but a 5% loss, we don't need a 100% gain. We need only a 5.26% gain. Okay? So here's the deal. What we did was we took the same parameters, the same winning-loss record, and we changed it from a loser into a winner by changing one thing, changing how much we had in the bet at one time. Okay? So we've done this. If you lose 50% every time you lose and make 100% every time you win, and you win less than half the time, is it possible? Is it possible to win? Well, not if we bet our whole stack. But if we scaled it down by 10, that's what I just showed you. If we scaled it down by 10, you could lose only 5% and make only 10%. All right? And then you would end up having great wins. All right, so here's the math behind it. This is called Skew, and mastering Skew and applying it, we're going to show in the next segment, we're going to show how to apply this to the market, okay? But mastering Skew is the first goal to trading successfully, and if you don't do this, if you don't skew yourself, you will screw yourself, and that's no joke, okay? All right, so let's take a look at how this is done, the practical on it. We call this the Radioactive Profit Machine. The Radioactive Profit Machine, or RPM, is a structure that skews your reward over risk. Okay, it skews your reward over risk. And here's how that works. If you've got a stock at this cost basis, for example, okay, and it could go down or it could also go up, all right? A lot of times folks are betting that it'll go up, right? Unless, of course, they're shorting the stock, then they're betting it'll go down. But if she goes down, you know, you could lose everything. You could actually lose everything. Could you also double your money? Yeah, you could double or quadruple or quintuple your money, right? But if you do, and then your next play, you lose everything, then you still have nothing, okay? 0 times anything is still 0. All right, so what do a lot of folks do? A lot of folks use a hedge. They will do a covered call, and I'll bet you there's a lot of folks in the room that have done it, okay? This is a popular solution for reducing the amount of risk that you take, all right? So let's say this is your cost basis. What we're going to do is we're going to reduce it a tiny bit this month by accepting a small premium, and that's going to lower the cost basis. See that? Now we've lowered the cost basis by maybe 3%. So instead of losing everything if the stock goes to 0, well, we could lose almost everything. We could lose all but 3%. That's really the risk that we're still taking. Okay, but here's what we're doing to the upside. We're capping it. Okay, we're capping it. Now, there's a problem here because what we've done is we've set ourselves up to lose when we're not right. I'm going to ask something here real quick, okay? Just the folks that have done covered calls for 24 months or more, okay? Whether you're at the end of your 24 months today or whether you did it at one point and then you bailed on it or whatever. But just, I don't want to get your input if you have traded covered calls for a week now, and hey, I sold a covered call and they got called out and I made 3%. Okay, 3% per month is 100% return on your investment. Okay, 6% per month is a 300% return. So if you click the first two, either you're telling me that you doubled your money in 2 years or you quadrupled your money in 2 years. Okay, and so I'm getting just the folks that have done covered calls for 2 years or more, and that limits the field. Not everybody's voting, but I do have some votes. Curiously, they're all in the same category right now. Okay, I'm going to leave this up for about another 3 seconds, 2 seconds, 1 second, close. Okay, now this only represents the folks in the room that qualified to vote. Okay, and that's you've been doing covered calls for 2 years or more. Now wait a cotton pick a minute. 100% said I'm about flat. I'm about flat. You know what's crazy is sometimes I get people telling me that they're losing money. They tell me I'm losing money. Oh, look, it says I'm losing money. I'm losing money, and I want an explanation. But you know what? At least these guys didn't get hurt, okay? 100% about flat. Now, how can that be? You got promised 3 to 6% per month. 3 to 6% per month compounded, regardless of market conditions. That's what you got promised, okay? I would demand money back from your seminar provider. I don't think it's going to happen, but I would demand it, okay, because this is just ridiculous. The claims that they're making, and with such a flawed system, it really is flawed, okay? What you're doing with a covered call, let me hide that and show the screen, is you're handing over to somebody else the privilege of taking away your stock if it's a winner, and you get to sit on the losers. It is sexy, the idea of sitting on a stock and getting paid while you're sitting on it. That is a sexy idea, but it just doesn't work out the way that a lot of folks are promising. Okay, so that's a popular solution. Now, here's what we're going to do. We're going to take a real practical solution. This is called the Radioactive Profit Machine. And what we're going to do is, instead of reducing our cost basis and doing a hedge that way, we're going to actually increase our cost basis. Watch this. Okay? By purchasing stock insurance instead of taking a small premium, you limit how much you can possibly lose, but your upside potential remains. Okay? So let's say that I'm going to make a small investment. Instead of sitting on my stock right here, I'm going to actually add to the cost basis and bring it up there. Now watch what happens. The covered call chart flips upside down. Now we have limited losses, but unlimited upside potential. And again, I know it's not sexy to spend money on insurance, but has it ever stopped you before? I mean, listen, if you drive, you probably have your car insured if you're responsible, okay? And you want to stay out of jail if you're in my state. In Colorado, in the United States, I know folks are in Germany and Switzerland. I don't know what the policies are regarding insurance, but here in Colorado, if you don't have insurance, you go to jail. They will imprison you if you don't have insurance on your car and you drive it. No joke. Let's see. How about your house? Is your house insured? What if it burns down? What if it doesn't burn down? Do you feel like you wasted your money on insurance last year? No, it's part of home ownership. Okay? What about an extended warranty on your computer or your cell phone? What about insurance on your life? You know, in case you kick it and your heirs are relying on you, your dependents are relying on you. The responsible thing to do is to buy insurance. And anyway, I'm not going to go on and on about it. I'm just going to say we do it for everything else. Why not do it for our money? Okay? Now, the big objection is, well, I'm going to limit my profits. You know, I'm going to spend 5% of my capital on insurance, and therefore I will take away 5% out of my profits. Well, is that how it works? Let's take a look here. Every stock has its own volatility signature, right? It could go up, it could go down, all right? But if a particular stock could go up by 15%, it could also go down by 15%. By introducing the put option to limit how much you can lose, but leaving your upside open, you introduce skew. And this increases your expectancy over the long term of winning. So instead of making 15%, you only make 10%. So what? Instead of losing 15%, you can only lose 5%. Okay? And while you're losing nickels but making dimes, you could actually be wrong more often than you're right and still make money. That is a revelation. Again, folks, the key to trading is not being right. It's trading right. Don't be attached to your stock and think, man, I've got to be right. No, just trade right. Okay, so here we are in another segment. What I'm going to do now is show you the practicals. We're going to take a trade from about a year ago. Now, every radioactive trading seminar or webinar online class that I do uses dated trades. Except for sometimes we've actually gotten into trades live. We've done that and had people track it with us, you know. In fact, I believe that this was one of them. I believe that Mike got into this one live, okay? But this was a year ago, and there's nothing super spectacular about this one, okay? It was a double-digit return, all right, but it wasn't like, you know, a double your money type proposition. It wasn't a triple-digit return, okay? Nothing really special, but I want to show you how this works. Here's an RPM, Radioactive Profit Machine. Mike put this together on March 6th last year, when the stock price was $49.45. At the same time, he bought a put option that was far away in time, 10 months away, okay, and above the current price, okay? So he's buying an in-the-money put option, $55 put, for $9.50. Now, you might look at that and say, wow, that's a big investment. And I'm going to say, wow, you know what? It's mostly guaranteed to come back to him. Mostly guaranteed to come back to him. Let's solve this put option and find out how much of this whole equation is really at risk. $58.95 is what Mike has invested. $55 is what's guaranteed to come back, right? At least. He's got to get at least $55 back as the stock goes down. If it goes down, he could exercise his put, right? Or he could sell his put and his stock separately, if you look at this red line, somewhere before expiration. Blue is the value at expiration. Red is the value before expiration. So if he gets out before expiration, if he's winning, he wins more. And if he's losing, he loses less. There's the skew. Winning more when you're right, losing less when you're wrong. All right. And so what he has at risk is $3.95, which as a percentage of this whole thing is 6.7%. Now, it's important that we understand something. Mike does not have any intention of holding this all the way to expiration. He may decide later to, but he doesn't have any intention at this moment of holding it all the way till expiration. He can get out if CAR decides to crash, he'll get out sooner. And this will probably be like less than 5% loss, okay? So $3.95 out of $58.95 is 6.7% risk. Now, here's the deal, okay? I'm going to take some questions here in a minute. I know that folks are posting questions. I'll get to them here in just a second. Go ahead and post your questions, and I will take a moment here. All right. I know what a lot of folks think. They think, well, that's not how you normally do a put option. The way you do a put option, the way you do a married put is you buy stock and then you buy a put option that's, 3 weeks out, a month out, 6 weeks out, not very far. And here Mike is buying one that's 10 months away. That's weird. Well, not really. You see, the thing is, your time value expires very, very quickly close to expiration. This is why we call this radioactive trading. There's an exponential drop-off in the price of the time value of a call or put option. An exponential drop-off close to expiration. Okay? But far from expiration, it doesn't drop off as quickly. So you'd think that buying that far away put is more expensive, but it actually isn't. The time value falls off very, very slowly. And if your intent is to only hold for a month, that's fine. You can still buy it several months out and then hold it for just a month and then liquidate. Okay? Nothing wrong with that. This protects you better and for longer if you decide to stay in. So while somebody that's buying a put option 30 days away, while they experience 100% decay in 30 days, okay, we would experience just a few percent decay in 30 days. Does that make sense? All right. So that's the first tenet of radioactive trading, is that we're going to buy time cheaply, and we're going to also sell it expensively. All right. Okay. Now, Here's what I'm going to give you here real quick, okay? I haven't taught you the income method. I haven't shown you income method number 5, which is really exciting, okay? All I've done is shown you that you can keep your risk down to 5% or less and still experience upside growth, okay? So I want you to think back to your record. Would the radioactive profit machine change it? Let's just be real honest. Your same picks and your same timing last year, but if you're a cover call trader, your winning stocks didn't get called away, okay, for a small gain. They got, you got to hold on for longer, okay? Or if your losing stocks, really hurt you, hey, guess what? You didn't take any losses of greater than 5%. If that's the case, tell me. Tell me if it would have done better. Think about what I just showed you. If every loss you took last year was scaled down from whatever it was to 5% or less, would it have been a better year? That's a simple question. Would it have been a better year? Okay, and we're coming close to the most exciting segment, and that's where I'm going to be teaching you a riskless spread trade that can pay you twice. Riskless spread trade that can pay you twice, and it's only one of the 12 income methods of radioactive trading. Okay, wow, we've got an even split right now. That's crazy. I hardly ever see that. I've got 33%, 33%, 33%. And they're all concentrated in the lower 3. I'm looking for another couple of answers, okay, because not everybody had a chance to vote. I know if you're calling in, you can't vote, right? But if you're in front of your computer, just take a second. Oh, boy, you know what? It changed, and then it went back. It was 33, 33, 33, and then it changed. It was like 38, 50. But now it's back to 33. Okay, now it changed again. All right, I'm going to leave that pull up for just another 3 seconds. So if you haven't made your voice heard, do it now. 3, 2, 1, close. All right, and it did change again. So now we've got 30% said yes. I may have lost last year, but I would have lost less. Okay, good. Would you be better off? I would think that would make you better off, right? Even if you lost last year with your picks and your timing, but you never had a loss of greater than 5%, you would have done better last year. Okay, good. 40%. Yes, this would make the difference between a losing year and a winning one. Ooh, now we're getting somewhere because I haven't taught you my top secret method for picking stocks. Because guess what? I don't have one. I haven't taught you my crystal ball method of knowing the future in technical trading because guess what? My crystal ball's in the shop. But what I have done is change you from a loser last year to a winner just by tweaking how much you expose to the market at a time. Wow. Okay. And then 30% said, you know what? I did well last year, but I would have done even better with this. So that's pretty darn fabulous. All right. That's impressive. Now, I'm going to ask, how much better? How much better off would you be? All right. Let's fill that one in. How much better off would you be? Assuming that you had the same win-loss ratio, but none of your losses were greater than 5%. How much better off would you be? How much more would you have to trade and put in the winning trades if you didn't lose as much in the losing ones? All right. Now, somebody came in and said, I didn't have any losses greater than 5%. And I think maybe those folks are blueprint owners. And if they're not blueprint owners, guys, you might be day traders. All right, you might be day traders. All right, let's leave that for just a minute. By the way, radioactive trading is pretty much the polar opposite of day trading. There are days that go by that I don't even look. I don't even look at what my stock is doing. Okay. All right. Let's leave it for another 3 seconds, 2 seconds, 1 second, and close. Okay, this is interesting because we had more, it looks like more than 100%, so maybe you could vote in more than one category. All right, we had 13% say, same. I'd be the same than last year. I didn't have any losses greater than 5%. 25% said I would be ahead by $1,000 or more. All right, and 75% said this would have made at least a $5,000 difference last year. Wow, wow, that's awesome. Okay, So having said that, let's dive into this, okay? What is different now? Okay, what is so different now? Well, what's different is we've introduced Skew. We've done it. We've taken that old trader's maxim of cut your losers short and let your winners run, and we've actually applied that son of a gun. We're putting it to use, okay? We're actually making it so that if our stock goes against us, our losers get cut short. But if our stock goes up, there's no limit to how high it can go up. Now, I'm going to talk real quick about another math thing, okay? And we'll skip through this. I mean, it's not going to be really long. But the reason that all those buildings are built so tall and can pay such enormous light bills, all right, in Vegas, the reason that those buildings are so tall and they can accommodate so many people is because they have a positive expectancy. You know, I was in Vegas one time, and I was in one of the casinos, and it said we pay 97% of our income back to our customers. 97% comes back to the customers. And I looked at the size of the place, and I said, wow, a 3% edge really does something for you. All right? What that means is for every dollar that gets played, they keep 3 cents, no matter what. Okay? And that is expectancy. To calculate your expectancy for what you're doing in the market, you want to take the the number of your wins and multiply that times the average size of your win. And you also want to subtract your number of losses multiplied by the average amount of the loss. So number of wins times average win, number of losses times average loss, and that equals your expectancy. Well, if we want this number to be higher, you know what we can do? That we can always affect, we can always change. We can change this number right here, average loss. If you change your average loss and bring it down, you bring up the expectancy of the whole equation. You bring up your expectancy for what you're going to take out of the market. Okay? Here's a gentleman named Mike Kepka. Mike Kepka is a good friend now. But back in 2007, he was the fellow that you would contact over at Power Options in order to learn how to plug in your particular parameters and find the kinds of plays that you want to find. Now, Mike is and was an options trader, but at that point, he had been impacted by losses. You know, he had done all kinds of different things like selling covered calls and selling naked puts, and he had won on a lot of those things, but then just one loss would take away, you know, several of his wins. Also, he had tried some things like calendar calls, where you buy a call that's far away in time and sell near-term calls against it month by month by month. And he told me that the greatest percent profit that he ever made was with that strategy. But conversely, the greatest loss that he ever took was also with that strategy, and it was for a net loss. All right, his winners never outpaced his losers. Okay, and so Mike got into radioactive trading. I was a customer. I called in and said, "Look, these are my parameters. This is what I'm searching for." And he says, "I don't know about that, Kurt, because what you're doing is you're buying stock and you're buying a put option the way nobody buys put options." I said, "Yeah." He says, "But I don't see how you can make any money with this." I said, "Oh, really?" And Mike began to, he came to one of these free webinars, and then he began to trade the way that I was teaching him. And what happened was, in 2008, even though he was long stock the entire year, he posted a 1.5% loss. Now, I know you didn't come to this webinar to find out about Mike losing money using my system, okay? But here's the thing. He lost 1.5% as opposed to 40% across the board, or like I mentioned, 56% with Apple Computer, okay? So for the rest of the market, he really outperformed them. Now, what happened after that? Well, what happened after that was a 6-year streak, and he's on track right now for the 7th year of double-digit gains year after year. Okay, so Mike learned how to get these things under control. His SLW position, I'm giving a quote here, Mike's SLW, silver wheaten position, was 300 shares plus 3 put options. I had only single-digit risk at the beginning. I saw his setup. It was 7% if the market completely crashed, but really about 5%, okay, because he would get out. If the stock went against him, he would get out early, okay. I had only single-digit risk at the beginning, but then used an income method and became bulletproof in the first 5 weeks. Now, what did Mike do after making his stock bulletproof? After getting his put option paid for by using one of the income methods, I went on to make 58.9%. Now, that's 58.9% based on not just the stock and not just the put, but both, okay? All right, now, here's what happened. Mike also picked another stock called TLM, Talisman Energy. And Talisman Energy lost 50% of its value. Oh, boy. All right, but his loss was only 4.5%. Why? Because he was using the Radioactive profit machine. So he had a similar amount invested, but only lost 4.5%, even though the stock cut in half. Mike says it was my biggest loss of that year. Okay, so if that's his biggest loss of that year, you know his other losses were less than 4.5%, right? So here's how that affected the formula. Okay, the number of losses times the average loss, that became very, very low, and so his expectancy became very, very high. And yes, obviously, he did very well. All right, Mike has learned how to slay the martingale. And that is what we're all about. Okay, now I'm going to go ahead and show that really cool trade that you're looking for, the riskless spread trade. Okay, do we have time? Let's see. I'm going to take a look at the watch here. Oh, we're at the top of the hour. Now, folks, I could go on if you'd like me to, or you can just punch out right now. Let me know what you think. Okay, would you like to see? All right. Manuel says, please go ahead. Yes. Okay. William's into it. Okay. Anybody else? Oh, Michael's going to stick around. Do it. Okay. Super. Here's what we're going to do. Okay. We're going to take a look at what we can do in the context, because we already said what is different now. What's different is we have taken and introduced Skew into our accounts so that we can leave our upside open, like Mike did with his 58.9% gain, but we also cut our loser short. Again, like Mike did, with his biggest loss being 4.5%. So what else is different now? Oh, go for it, says Juan. All right, I'm going to go for it, Juan. Check this out. Within the context of your Radioactive profit machine, income can still be generated 12 different ways. Now, you could probably think of 2 of them off the top of your head, okay? You probably realize that selling a covered call might do the trick. You probably realize that you could trade dividend yielding stocks this way. And both of those are true. So what about the other 10 ways? Well, let me go ahead and show you one. Okay, using the income methods, we can generate enough premium to offset the cost of the put. Okay, so we're going to either reduce risk or take income or both. The Radioactive trade income methods enhance the skew. So if for example, we could only lose 6% or 5% at the beginning, right? Then we take it down to maybe 2% or 3%, or less. In fact, it's possible to take it to no risk, take it all the way to bulletproof. And that's what I'm going to show you today. Or I'm going to show you part of the journey anyway. So here's Mike. Mike is in Avis Budget Rental, a car rental company. And ironically, the stock symbol is named CAR, okay, car. So Mike gets into car. I think we already showed it, right? We already showed the setup of car where he bought the stock and then he went 10 months out and he also bought a put option. Okay, so with that in place, Mike then takes the May $55 calls and sells 2 of them. He sells 2 of them, picking up $3 in premium. And at the same time, the exact same time, this is a spread trade that he enters with one order and one commission. He gets filled at $2.60. He's buying the May 5250s and he gets filled at $2.60. So that makes a net credit of 40 cents. Now, that may look like not enough. In fact, when you look at the fact that with just a a plain vanilla covered call, he could take in $1.50. If he just sold one covered call, he could get $1.50. Why would he want to only take 40 cents? Well, it's because of what he suspects may happen. He believes that CAR may go up. He's not sure if it will or not. So he's going to take a 40-cent credit right now, but later on, he may get even more. Okay? Now, normally, this kind of play is called a ratio call spread. Because it's done in the context of a radioactive profit machine, it's an income method. All right? It changes the whole deal. All right? But just doing this play by itself is called a ratio call spread, and it's kind of dangerous because what happens is, yeah, you get to keep your 40 cents on the front end. Some things may happen later on where you actually collect more. All right? But if the stock goes way, way up, you're in trouble. Why? Because you're naked. Naked. I used to work in an emergency room, and I found out that most people should not be naked. All right? What's happening here is we've got one call and two short calls. So one of these calls is not covered unless we already own the stock. Because Mike already owns the stock, one of his short calls is covered by his ownership of 100 shares of stock, and the other short call is covered by his ownership of this call. So all this red water goes away, all right? He doesn't have any of the risk that's normally associated with doing a ratio call spread, but he does get to keep this 40 cents no matter what, and if the stock goes up, he may, or sideways, he may be able to get paid again. Okay? Kind of cool. Now, when May expiration came, Mike had the option, not to make a pun, but he had the option of getting out at a decent profit or holding on to his Avis budget rental stock. Okay, on expiration Friday, Mike decided he wanted to keep his car, and this is what he did. He set an order to close. He sold his May 5250 call. This is on expiration Friday in May. His May 5250 call for $2.35. Why? Because it was in the money. At this point, CAR was trading at $54.80. It's in the middle of the day. And by the end of the day, CAR was trading at 55 and change. I think it was 55.16. So he would have gotten called out of 100 shares of stock if he'd allowed it to happen. So this is what he did. He unwound the trade. He closed this one, and he bought to close those May 55 calls for 15 cents a piece. Okay, so that cost 30 cents to do, but here's the net. He gets a second credit of $2.05. Now, remember, it paid him 40 cents to open this in the first place, and now he's getting paid $2.05 to close it. How about that? So that's $2.45 total that he's collected. And if you'll recall, $1.50 is what he would have gotten out of covered call play, minus he would still have to pay 15 cents to close that covered call, right? Okay, so $1.35 is what he would have done with covered calls. $2.45 is what he got with income method number 5. So that's 80% more premium collected than a plain vanilla covered call. Okay, guys, what do you think of that? First of all, I'm just going to say, what do you think of that? You know, is that cool or what? What do you think of the income method I just showed you? You know, you can use this premium that you collect to offset the cost of your put option. All right, we got 100%, 100%, 100%, 100%. Very good. Okay, there's you can vote in more than one category, and the first person to reply put 100% in each. He was happy with everything. Okay, good. Let me leave this up for just a few seconds. I don't want to belabor the point. I do want to see what people are most excited about. Okay. What you're most excited about. So I'll leave it up for another 3 seconds, 2 seconds, 1 second, and close. Okay, 25% said trickle away the cost basis little by little. I dig. I'll show you that here in just a moment. 75%, this is the winning one. This one trade made it worth all the time I spent here today. Really? Cool. You know what? You should maybe invite somebody to come to your next radioactive trading seminar. Because if you dug this, just imagine, this is big stuff. And we're committed here to teaching folks how to, number one, stay out of trouble. After that, winning almost takes care of itself. But then number two, to know these special setups, these special structures. Okay, 38% say, I want to know more about riskless spreads like this. Well, you're in luck because I'm going to give you the best offer that's available for the blueprint and the 12 income methods. 25% say, can I do what you just showed in an IRA or similar account? Okay, now you're going to have to check on two things. Number one, your country's laws, all right? Because I know that Canada, for example, has got something similar to the U.S.'s IRA, okay, the individual retirement account, which lets you do trades like this in a tax-sheltered entity, okay? You're going to have to check and make sure that it goes along with the laws of your country. Number two, you're going to have to make sure that it goes along with the rules of your broker. Now, what I've just shown, I know that Thinkorswim and Options Express and other more enlightened brokers will let you do because it doesn't actually require margin. It doesn't require margin. Your shares of stock, all right, are what ensures that you don't need margin here. Okay, so if your custodian of your IRA won't let you do this, you can change. Also, there is a workaround that we have that makes it legal for brokerages that wouldn't allow it. And it's a workaround that is contained in the blueprint, okay? All right, and then 63% said, I especially like bulletproofing. Is it really possible, though? Yes, I didn't just show you a unicorn, okay? I didn't just show you a hypothetical. This is a real trade done with real money by a real guy that is a student of my system. And, it's not the best trade he's ever done either. It's just, this is a nice example. All right, so is it really possible? Yeah, it's possible because here's the deal. Mike's, the radioactive profit machine, Mike's setup with the stock plus a put option has this structure to begin with. And this red water down here is $3.95 worth of possible losses. Well, after he collects $2.45 in premium in 1 month, wow, that becomes $1.50 that he could lose. And then he collected premium again and was what we call bulletproof. And he continued to play CAR for, I believe, a double-digit return. I do know that he was bulletproof, and at one point he was at a place where even if he closed his eyes and took a nap and didn't do anything, his broker would have got him out of this at a 9% profit. At expiration Friday. It would have been what they call automatic assignment. So anyway, Fitzroy asks, what is the combined delta? That's something that we talk about in the blueprint, Fitzroy. And the combined delta of, for example, the stock plus the put, it's actually, you subtract the puts delta from 1, and that's what you get. I hope that made sense to you. Okay. Oh, the combined delta of the whole position. Well, that's something that can be expressed in the power options chart. Okay, power options chart. I may be able to show that maybe next class. We're running over schedule right now. Okay. All right. So great questions. Let's see, folks. I'm not going to do another poll here. Normally I would do another poll. I'm going to not. I'm just going to go ahead and finish up. Income method number 5. What I just showed here. Income method number 5, which it has a name. Ratio call spread is how this particular spread play is called when you do it by itself. When you do it in the context of a radioactive profit machine, it's the 5th way that we teach of taking income without adding risk. Okay, so within the context of your radioactive profit machine, you can generate a credit, but without any of the capital risk. A ratio call spread has it has infinite risk when it's done by itself. But when you do it in the context of owning the stock, it has none of that risk. Why? Because that which makes there be any risk at all is the short call and uncovered. And the thing is, we've got the stock to cover it. Apply the income methods to lower your risk or your cost basis of both, and you might end up with a Mary put with all the time value paid for. But your upside is left intact. You know, after expiration, Mike returned to a radioactive profit machine. He returned to a married put play with unlimited upside potential, but limited downside. Okay, and then finally, no downside. And we call that bulletproof. Okay, now here's a quick reminder. You may not get all this in the first viewing. That's okay. Number one, if you purchase the blueprints, you can use your support and pose us questions at any time at support@radioactivetrading.com. All right. And with regard to this particular play, if you want to see it again, we are going to have a replay available for a couple of days. Okay. So the income methods are used to reduce the gap between what you could lose and what your cost basis is. Okay. And then when we reduce that gap, we can reduce it even greater. The phenomenon of bulletproofing is to where we've reduced that gap to less than zero, and yet we retain our upside potential. And that, to me, is really sexy. Okay, that's what we call bulletproof. So what should you do next? Okay, after this primer on limiting losses and bulletproofing, remember I only showed you one of 12 income methods. All right, and I've shown you Mike's ability to bulletproof himself. All right, I would like for you to take a look back at your trading record and ask yourself this honest question. We already had this done in today's class, okay? But if you're watching the recording, think about it, okay? Here's what I said to the gang. I said, think about what I just showed you. Limiting your risk to 5% or less on your losers, what would that do to your record? 100% of those that answered this poll said that they'd be better off. 30% say, hey, I might have still lost, but I would have lost less. And that's before I showed the income method. And then 40% said this would make the difference between losing and winning. And then 30% more said, you know what? I did win last year. I did well, but I would have done better if I'd have been practicing this way. Okay, so that's what I'd like for you to do. That's number one thing, okay? If you had the same picks and the same timing, but you had no losses greater than 5%, wouldn't it be a better off situation for you? If the answer is yes, you need the blueprint, okay? I've given you a bit of a primer, but there's more to it than I could possibly share in an hour and 15 minutes, okay? Number two, consider how different things might be if you could take income. Did covered calls limit your upside? You know what? There are ways which, number one, can get better return. But number two, there are ways to take income and leave your upside completely open. I didn't show that today. All right. The ratio call spread would still put a cap on your upside. All right. But there are ways that we practice that will leave the upside open completely. All right. All right. So let's examine the value of the blueprint at radioactivetrading.com because many of you don't still have it. Some of you said that this feature of never risking more than 5% would have meant $500 or more to you last year. Okay. Do you expect to trade for another 10 years or more? Well, if that's the case, then this information by itself is worth $5,000 to you. Some folks said that it would have made a $5,000 difference last year. Let me flash that back up there again. Okay. How much better off would you be? 75% of those that answered the poll said this would have made at least a $5,000 difference. Okay. Okay, so what's 10 times $5,000? You know what it is. You know what? I would be able to charge that and still have good conscience. I would, because I've actually had the privilege of coaching bigger fish than me. I've had a number of folks with 7-figure and even 8-figure accounts ask for radioactive trading strategies. Okay, 8-figure account. You go ahead and work that out. You know, it's multiples of, $1 million. 7 figures is $1 million. 8 figures is greater than $10 million. Okay, and so I would feel okay charging $50,000 for this information, but I don't. Not even a tenth of that. Not even the $5,000 that this would be worth to most of you. Okay. It's more like $600. $600 is what we charge for the home study kit, and shoot, you could even get by with the $339 that we charge for just the blueprint. Okay, so here's the home study kit. The home study kit, I've got listed here some bonuses that only come with this offer, these Iridium bonuses. I'm going to give you the link to that in just a minute. But there's a number of bonuses here that added together, they cost more than the blueprint itself. The home study kit is the blueprint plus 6 CDs, which teach in an audio-visual manner, a multimedia way, all these techniques. Okay. Now, if you learn better that way, then this is your best value. But if and $600 is really, what it's much less than what it's worth. Okay, but if you only want to read it, okay, if you think, well, shoot, you know what, just give me the written word, that's all I need. Well, fine. The blueprint itself, stripped out of the home study kit, is $339 plus shipping, depending on your destination. But $339 is all that's going to cost you. Okay, so when we consider the cost and against what it is definitely worth to you, it's kind of a no-brainer. All right. Now, if you order the blueprint today, you'll get the RPM setups that ensure that you'll never lose more than 5% or less. The 12 income methods that will teach you to take premium out or reduce risk or both. Okay. And you get support. You get a second set of eyes for your trades as you're beginning and trying your legs in this new type of situation. But here's the most important part of today's class. The most important part is if I'm going to encourage you to go and learn how to be bulletproof, shouldn't that offer be bulletproof, right? So let's begin our relationship this way. When we talk about the guarantee of having a stock with a put option in place that guarantees your exit price, all right? Well, the exit price, still, you could actually lose a little bit of money unless you've bulletproofed yourself. Bulletproofing usually comes later, okay? Usually you buy your stock and your put simultaneously and then use the income methods to whittle away at the cost of the put. But after that has happened, now you are what we call bulletproof. You have unlimited upside potential, but no risk. Well, that's the way that we structured this offer. All right. If you pick up the blueprint or the home study kit and you decide later that it's not what you wanted, guess what? Go ahead and return it. You get 100% of your money back that you spent on the blueprint. Okay. Or the home study kit. If you don't love the blueprint, call us up or send us an email. We'll refund every penny. And we don't process a lot of returns, but the returns that we do process are swift and they are painless. All right, we're not going to try and talk you into it. What will it cost you not to have the blueprint? Some of you folks told me that it would save you $500 last year. Some folks said $1,000. Some folks, 75%, said at least $5,000. Okay, that's what it cost you not to have it last year. Do you intend to be in the same place next year or no? That's a real simple but fair question. So, cool. Okay, guys, I'm going to punch into the questions here again. Okay, Manuel says, maybe a stupid question, but I'm not an options expert. Can you apply bulletproofing to a short naked stock strategy? Manuel, we have something in the blueprint that takes advantage of a down market, which is what I believe that you're driving at there. But it does not have all the caveats that normally doing this way. What you're talking about is shorting stock and buying a call, right? Instead of buying stock and buying a put, you're shorting stock and buying a call, right? Well, there's actually two alternatives to that are a lot easier to do and don't require margin. So, good question. Les says, why not just take your max loss and whatever the married put would be and use that amount to buy a 10-month out of the money call? Another good question. Les, you might have missed the beginning part of the presentation where I showed that you force yourself not to risk too much when you do the married put. If you do a long call, two things. Number one, your position sizing is not calculated for you. Okay, your position sizing, it's very tempting to take too big of a position. Number two, with 12 different income methods, some of those income methods involve manipulation of the put option itself. And that would not be available, and some of the plays that we do would not be available without a high trading clearance. But with a Mary put play, those trades would be available without a high trading clearance. And some of those plays that involve using a put would be possible. So you're talking about a synthetic position. Les is talking about a synthetic position. Guess what? There's no necessity for a synthetic position, and you automatically do the type of position sizing that makes sense. Okay, great question. Okay, folks, we are over. Thanks for keeping me. You know, I could spend all day talking about this stuff. It's a lot of fun, but I should really let you go. William says, "Great again. Thanks, Kurt. Thank you, William. I appreciate your presence." And William's a Blueprint owner and still comes to these classes to tune up and to participate. And I sure appreciate it. They're sure. Okay. Folks, I'm going to go ahead and leave it there, and I need to give you the link. Okay, so let me see if it's I've got a prepared slide. I think I do, and if I don't, I will send it to you. Okay, by the chat box. Oh, okay, this is a testimonial. Dear Kurt, I've received the blueprint. I'm a total believer in the methods. Thanks so much for sharing the idea of bulletproofing my stocks. In the last 6 months of trading, even though 6 out of 10 growth stocks cratered, I was able to manage all of them with absolutely no loss. So what this fella did was he bought stocks plus put options. 6 of those stocks went down, but his income received from the income methods offset the loss in the stock, and he was able to get out with the stock and the put and not suffer any loss. Okay. In fact, it says in some of them, I even made money. Okay, so he buys stock, buys a put to insure the stock, gets out at a profit even though the stock dropped. Okay, I wish I had known about bulletproofing a year ago. What's most heartwarming for me is that almost all of my portfolio is bulletproof. Thank you again so much for the blueprint. And that's Sudhakar Rajlu, who's a pupil of Radioactive Trading. So, very nice. Okay, there's the link. That's what I was looking for. Radioactivetrading.com, and if you will follow it with /IRIDIUM, the chemical element iridium. If you follow it with that, you'll get the best offer that we have on the blueprint, plus 5 different bonuses. Juan says, "Thanks, Kurt. I am learning more and more." Thank you, Juan. By the way, I looked at your website. I appreciate your furniture business, and might have some ideas for you. Les says, "Sorry, but that answer doesn't make sense, as you would not take too large a position." Okay, Les, you would be tempted to take too large of a position if you had $10,000 and you're spending $200 on a call. You might think, maybe I could get 5 calls or 8 calls or 10 calls. Okay, that's actually just human nature. Or you might get into one call and forget to put the rest of your $10,000 on deposit and trade in another stock's calls, another stock's calls, and another stock's calls. So by buying the stock and a put option, you paint yourself into a corner where you can't overtrade. And then the rest of the answer, I'm sure, makes sense to you, Les, when I said that with 12 income methods, at least 3 of those 12 income methods involve manipulating the put, which you can't do if you don't own a put. All right, so very good. Okay, folks, I'm going to go ahead and close it there. I want to thank everybody for coming, and even folks that are naysayers. We take all comers. We've been doing it for 12 years now, and have yet to be proven wrong. We've had yet to have a losing year. So, all right, folks, we'll see you out there, and bye for now. Happy trading.